Now, journaling is pretty simply just a process of recording and reviewing your trades. Now, make sure you're not digging your head into the sand because I've given up being shocked at how many traders I chat with that do not track their edge meticulously. Not journaling your trades is pretty much the first sign of a punter who's just aimlessly charting every weekend. Because the sad reality is that there are very few traders who actually know the truth about their own trading. People don't want to know the stats. They just want to gamble and they just want to win big. But there is a deep psychological reason that most people won't collect performance metrics. Because people want to believe just based on faith and to not actually be confronted with cold, hard facts. They don't analyze and review the trades that they have taken just because they want to disassociate themselves to avoid the pain of their losses. But reviewing your losses, particularly early on in your journey, that is where the growth lies. And that's generally where the easiest and the biggest gaps for improvement are, where you can kind of make those big quantum leaps forward. As professional traders, we are seeking constant evolution and progression, and this process will help to make sure that we are on that path and that we're not just stagnating or worse, even going backwards. Digging through your journal is the work that other traders, they're just not doing. So if you do it, you are automatically giving yourself a massive edge over them, over the rest of your competition in what is ultimately a zero-sum game. You should constantly confront your performance head-on, and that starts with the post-analysis of your results, because as the famous saying in business goes, what gets measured gets managed. The most valuable information about your trading is your trading. So again, journaling is the process of recording and reviewing your trades, and really there are two main aspects to journaling. So there's the quantitative side and then the qualitative side. So the quantitative process of journaling your trades is just essentially being the accountant for your trading business. So you are crunching the numbers, tracking your P&L, your strike rate, the size of your average loss and your average winner, your profit expectancy, and there's just those sort of key numerical metrics like that, right? So generally you would download your trading account statement from your broker and you would record all of your trading data in a spreadsheet application, like Microsoft Excel or Google Sheets, for example. And there are also some automated softwares that can do this for you too. Now, this is a great start if you're doing this already, but a lot of people do not take their journaling any further than this step. And the problem with that is when you kind of get all of these numbers, spat out, the data, it very rarely paints the full picture of what is actually going on with your trading. Because imagine that your spreadsheet trade journal, let's say that it's telling you that one of your setups is performing really poorly, right? Well, after a certain point, if it continues to show poor numbers in the journal, the obvious and the logical thing to do would surely be to stop executing that strategy altogether, right? Or, at least pause it until you figure out, how you can improve it first. But unless you actually look at your trades, you don't really know the full picture, because maybe it's just you that's actually underperforming the actual strategy, because maybe you've made mistakes executing it, or maybe you've just missed a lot of setups that were winners that week or that month that actually would have made the strategy perform really well. But if that's the case, again, that's okay, because you can actually take some confidence from that, because you've now figured out the issue that, actually your strategy does work, but you just need to make a few little tweaks to make sure that you are executing correctly, and then the results will follow. So you need to be measuring your own personal performance discrepancy against the actual strategy performance. And by looking at that gap, at that difference between your performance and the actual strategy performance, that is where you figure out how to improve, and that is where the refinement comes in. So in order to fully understand the story behind the numbers that the spreadsheet spits out at you, you need to actually look at your trades and really deep dive into that and try and identify what is going on behind those numbers. So this is what we call the qualitative analysis, which essentially is just where you're taking more of a descriptive approach, to dig deep into your trades, and you're looking for any common patterns that keep occurring again and again. So you'll store the screenshots of all of your trades after you have executed them, or you can take screenshots just before you're executing them as well if you wish to do so. But then afterwards, you will write down and you will describe the different elements of your trade. So of course, both the higher time frame analysis, the medium time frame, and then your lower time frame execution. Obviously, the reasons why you took the trade, how you entered it, where you placed your stop loss, how you managed it, right? Everything that's involved in the actual execution and management of the trade. But you were looking for ways that you could improve the trade or identifying where potentially you have made some mistakes. and then just noting any of the key lessons that you took away from that specific trade once you've reviewed it. Now, what you can also do is you can track your emotions when you are executing the trade and during the trade when you are managing it. Right, so when you're in the trade, you can write all of these emotions out, what you were feeling. Maybe if you felt the urge to cut the trade early, or maybe if you did cut the trade early, write in why you did it and the emotions that you felt. And then when you look back over your trades, this will really give you an amazing insight into actually how your emotions may be affecting your edge and your overall performance. Because once you do that, that's when you can then go back in and objectively see what is happening, from your emotions getting involved. And then you can start to implement some, practical solutions to try and help you prevent your self-sabotage in the future. But really, you can only do that if you do the work and you start tracking that, now as you're trading and as you're going along. So the qualitative side, it definitely takes a bit more work because it's all about self-review. And this is really, it's about looking at your trades, your trading routine, but very importantly, it's about keeping yourself honest. You have to be ruthlessly and explicitly honest with yourself, which in reality, most people find this really, really hard to do. But it's how you get that rapid growth. Now, I've built you a trade journal, for your trading dashboards on Notion that incorporates both the quantitative and the qualitative side of your journaling. So you have that all in one solution, in one place, just to kind of try and make it as seamless as possible. Because remember, this entire time, right? We understand the process side of our business is extremely important, but we need to try and kind of adhere to that as much as possible by trying to make that work feel like play, right? Now, we'll go through those processes in the next lesson, and I'll show you exactly how to use it and how to perform your journaling process. But something to consider when you are journaling and reviewing your trades is that any trade will generally always fall into one of these 4 scenarios. Now, the first scenario is a trade that is a valid trade. It meets all of your trading plan rules, and it is also a winning trade. These are obviously great trades. Now, once you have journaled these trades, following your usual process, which we'll take a look at in the next lesson, I would also save a copy of that trade review in another folder, maybe in your trade plan section, right, on your Notion dashboard. If you have a look on there, there will be a folder underneath called setups. And what you can do is you can put tons of examples in there of your high probability winning trades that are obviously, valid with your trade plan rules. So these are the trades that you want to be constantly looking at and just burning them into your subconscious of what an ideal setup actually looks like. And you want to be looking at these, before, during, and after every single trading session. So you're just constantly looking at them. Now, the second scenario is where you take a valid trade, but it just happens to be a losing trade. So this is a trade that meets all of your minimum criteria on your plan, but it just didn't work out because of the probabilistic nature of trading. So these are the losses that you want to celebrate, because you are executing and analyzing with consistency. So as long as you continue to do that, you will be one step closer to your next run of profitable trades. Now, the third scenario, this is when you take a trade that does not meet all of the minimum criteria of your plan, but it happens to work out and it's a winning trade. Now, you need to be super, super, super careful of these, because most of the time, these are usually trades that are not within your plan, but you just happen to get lucky. Now, of course, if you start to notice this particular setup play out a lot, that at the moment it doesn't currently meet your rules, then you may now have developed a new edge. So of course, then you can build a new sort of plan around that, and then go and test that new plan to actually see if it holds up over a large sample size of trades. But for the most part, you must be explicitly honest with yourself here, because when you realize that if you took a winning trade but it wasn't actually valid, you just got lucky. And luck is not how you remain consistently profitable in trading. Now, the fourth type of trade are those which are not valid and they don't work. So these, in my opinion, are kind of the only trades that you should really try to learn from on the losing side. They can be sometimes quite hard to differentiate from the second type of trade, where it was a losing trade, but it was actually valid. So this is where you need to have those really clear rules in your trade plan. And these trades, these fourth type of trades, they are usually a result of a fundamental problem in your analysis or your execution. So when you analyze a trade, you will usually see that it doesn't meet all of the criteria of your trade plan, or maybe you managed it wrong, or anything like that, where you didn't perfectly perform all of the rules within your plan. Okay, so they are the 4 types of trades that every trade you take will fit under. but just make sure that you have a section in your journal that states whether a trade is actually valid or not. And this will really help you to see, what potentially may be affecting your results and which trades you really need to dig into, to look for reasons potentially why you took that loss there. Or maybe it's just a trade that falls into the second category where it was a loss, but it actually was valid. And then you don't need to worry about over-analyzing it to potentially try and figure out where you went wrong, because this is just where the probabilities of your edge are playing out. Now, before we look at the steps of the journaling process in depth in the next lesson, I just want to end this lesson by discussing the topic of how to measure your progression. Now, there are countless ways to measure the performance of a trader, and the most sort of obvious metrics to judge our performance by are our profit and loss and our drawdown. Now, these metrics are often expressed against a period of time. People will often say, oh, I made 10R this month, or I had a 5R drawdown last month. They're all pretty common phrases, right? And there's absolutely nothing inherently wrong with that. Expressing performance metrics per period of time, that does give us a better understanding of how past performance came to existence, and it helps to estimate future performance. However, the timeframes over which performance is measured and expressed varies greatly. A major difference can be seen in how investors measure their performance and how traders measure their performance. Now, in the world of investing, the focus is generally always on long-term growth and returns, and most of those types of funds, they will only focus on the year-on-year or even 5-year performance, because their approach to the market is long-term and they do not engage in day trading. So the pace of their activities and the pace at which the market moves suggests that the most reliable measurement is at least a minimum of a 1-year time frame. Now, on the other side of the spectrum, there is the day trader, who is obviously focused on short-term gains but long-term compound growth. So a day trader wishes to know how they perform on a monthly or even sometimes a weekly basis due to the fast-paced nature of the trading style. Now, naturally, the majority of us here in Photon, we will be monitoring our trading performance on a monthly basis. Now, the reasons for this are quite simple. Our trading style, it allows us to make significant monthly gains and therefore allows for the monthly measurement of performance. Now, I'm just going to replace the words investment funds and traders with business and employee, because you may be, or maybe even aspire to be, a full-time trader, and you will need a monthly form of income to live off. We are programmed to translate income to monthly payments because of our financial obligations and also the salaried employee mindset. And that employee mindset, it just forces you to think in monthly cycles, and it really gives you that short-term horizon. But you need to develop a trader's mindset, which is essentially a business mindset, which thinks in and reports in quarterly and annual cycles, and they are fixated on the long-term horizons. So measuring and expressing your trade performance per month, it can give the wrong impression of your true long-term performance. That's why hedge funds and investment firms, they will rarely publish monthly results, because their focus is on quarterly, 6-month and annual results. The reason for this is that monthly performance is just simply not relevant if you're in it for the long run. Just like the trade-by-trade reaction, our month-to-month performance, that can really dictate a huge part of our emotional state. Individual monthly results, they can be an inaccurate representation of your true long-term performance. Now, I measure my results on a monthly basis, but I only evaluate my results every quarter. So that means that my focus is on the quarterly results and the big picture, instead of monthly performance swings, which market conditions and simple probabilities, they play much more of a role in when you're looking at your results on that time frame. So here's a quick little thought exercise that I'd like you to try for a second. Now think about, let's say you were testing a strategy to see how well it performs, and you only tested the strategy on just 1 month of data across, let's say, 5 trades. Would you then use that data to make any sort of judgment or base any decision on that in terms of how the strategy performs? No, of course you wouldn't, because it's nowhere near a big enough sample size of data to draw anything near a statistically significant conclusion from. So don't do the same from your own individual monthly results. Zoom out. And even measuring your performance on a quarterly basis, that can still be pretty, short-sighted, but it will help to remove any emotional involvement and distress on those shorter-term swings. Just remember, if you are in it for the long run, then why would you get emotionally involved with short-term results? It's just irrational. Now, if you do happen to get a negative return for a quarter, then generally there are only really three things that can be happening. You're either breaking your rules and you're not sticking religiously to your tried and tested and proven trade plan, or potentially you may have missed way too many trades, so you're not seeing your true edge play out because you've missed some winners that should be part of your probability model, or the only other final option is that you just simply do not yet understand your strategy. So this is why we perform qualitative analysis when we journal and when we review everything after each quarter to see which one of these three areas is causing the issue or has the biggest room for improvement. Now, if you can isolate which of these elements is the issue, you will see the biggest improvement in your long-term performance. I can absolutely guarantee you that. Once you find the root cause of any issue, only then can you begin to put the right solutions in place. So this is why in-depth journaling is really vital to your ongoing success. Obviously, the bigger the sample size of data you review, the more significant the conclusions that you can draw from it. So when you record and review an individual trade, a lot of traders will take the outcome of that individual trade into their decision-making process. They'll take that over into the next few trades that they take. And this is a textbook example of recency bias. So let's say that you review a trade and you see that if you had managed it slightly differently, you could have made an extra 5R. But then what a lot of traders do is that then they go into their next trade and they try to manage it that way, right, in their next trade, instead of sticking to their management rules that they have actually tested over a larger sample size of trades. So if you kind of, learn something from a previous trade, but then you instantly and straight away, adapt your rules to fit that last trade, and then you bring that into the management of your next trade, over the long run, that's just going to be a recipe for disaster. Because remember, the outcome on an individual trade, it's irrelevant. We are working with a random distribution model. So, watch the Trading and Edge module if you need a refresher on probabilities in trading. Now, at the weekly level, when you review the entire previous week, you are simply looking to see if you made any mistakes by not following your plan to the T, and also looking to see if you missed any trades that actually are a part of your plan. Because only when you start to get to that monthly level of reviewing and higher, then can you begin to look for any patterns that may be forming. So these patterns could be psychological errors that you were making, potentially such as not executing trades, or maybe you keep cutting trades too early, for example, or things like that. Or they could be patterns in the actual strategy that actually maybe you have followed your plan perfectly, but let's say that you notice that you got stopped out of a lot more trades, maybe just by a few pips before it then actually reverses and it moves back in your favor. Then you know that your just stop seems to be a little bit too tight. So now you have something to dig deeper into and figure out if your plan may actually need adjusting, as this seems to be something that is happening quite a few times. But it's really kind of only when you get to the quarterly level, when you review your previous quarter, that is where you can start to make serious considerations if your trade plan needs adjusting and tweaking, because now you have a much more significant sample size of data, over 3 months to draw conclusions from. Now, when you perform your annual review at the end of the year, this is where you can make the biggest improvements in your strategy and also your own human performance and adherence to your plan. And it will be much easier to isolate and identify what's holding you back, what psychological blockages you may have, or potentially what glaringly obvious part of your strategy can be improved. Then you can devise a clear plan of action on how to overcome it. You only get better in this game by one way, and that one way is self-analysis. Reviewing everything that you do at each level. What am I doing well? What am I doing badly? What are my major weaknesses? What are the specific steps that I can take to become a better trader? You have to persevere in a way that is conducive to you improving as a trader, not just simply doing the same thing all the time. Almost nothing in the real world is linear, and that includes trading. If you are an ambitious person, and if you have a growth mindset, you are seeking that constant progression, that constant growth, and that constant evolution, then measuring your progression with trading results, it can be a bit tricky. Here's why. Let's say that you've been working really hard and putting in the work for a long time, and then you've just had your biggest ever monthly result. Happy days. You are seeing your hard work and your progression naturally paying off. But then the next month is slightly slower. Maybe there are not really that many great opportunities in the market, but there are a lot of average opportunities that can catch you out and really start to bring your results down, over a long period of time if you are kind of still consistently taking those, rubbish setups when you should be cutting them out. Now, this affects a lot of traders, and it used to catch me out all of the time, because the mindset of having your biggest month ever is that you want to constantly feel that growth and that evolution, right? But if you still have that employee mindset, if you know that month-to-month P&L, then that is how you're going to measure your improvement. You're going to have a negative emotional effect when you've just come off your biggest month, and then there's not a lot of opportunities to take the next month. And the mindset behind that is that you're probably going to start taking trades that you shouldn't, because you want to beat that previous month, to prove to yourself that you are constantly evolving, that you are actually getting better and better. Human intuition is to measure your improvement and growth by the physical results. So with trading, that is typically just focusing on your P&L, right? So it's the mindset and the psychology of how do you deal with the fact that you are constantly improving, but yet it doesn't necessarily directly reflect in your P&L. If you measure your progress when you are learning purely from your P&L, it is going to incentivize you probably to take unnecessary risks in order to try and beat that previous month, to prove to yourself and probably to prove to others that you are making progression. But this is the hamster wheel of the break-even dance. So try not to fall into that trap. Because I know how it is. You've got your friends and your family, they know that you're trading, and I'll ask you questions like, well, how much did you make this month then? And it can be really frustrating at times because they just don't understand it. And to be fair to them, it's not their fault, because profit and loss seems to be pretty much the most obvious metric to measure progression by, right? But we know that it's not really that simple, and it's not fair for you to be judged on that either. Why? Because it's just simply not an accurate measure of your progression, especially in the short and even the medium term, because we're dealing with the random environment of the market. So just because you are getting better, your mindset is getting better, your technical analysis is getting better, but you just haven't finished this month with as much profit as last month, then it's all about the mindset of that is not how you measure your progression. You have to be looking at the momentum you are getting. Keep that going. You have to reflect on how far you have come since last month, over the years, and keep that as your fuel, and keep that as your fire. Because you can be constantly improving month on month, but that doesn't necessarily mean that trading the market will allow you to see you directly reflect that on how much money or maybe how much percentage you are making. And that is not how you should be measuring it. Most things in life, you can consistently improve your skill set each month, but it won't necessarily be reflected in your performance, but that does not mean that you are not getting better. So this is why we focus on process-based goals and not outcome-based goals, especially in the short term.